Good evening. Thanks for joining us. The top stories today. The Fed seems pessimistic about the economic recovery. It's just released its minute meetings from July. We have analysis on that. Will we see a wave of mortgage foreclosures? Delinquencies on some government-backed loans are at all-time highs and growing. We speak with the director of AEI Housing Center at the American Enterprise Institute. Retailers Target, Lowe's and TJX all reported earnings today. Target posted strong online sales. Lowe's benefited from people making home improvements, while TJ Maxx was hurt by stores staying closed. And Apple becomes the first American company to reach a market value of $2 trillion. It's thriving even after supply chain disruptions and store closures. The press secretary says the White House is open to supporting a bill to provide funding for the Postal Service, but it wants the bill to also provide aid for unemployed Americans.
I know the Speaker is interested in potentially a skinny bill with post office funding, but what we want here at the White House is we're certainly open to post office funding. We did, after all, offer that $10 billion that was turned down, so we're open to that.
She also mentioned the president's idea about raising prices on Amazon packages as a way to fund the USPS. She said Amazon is taking advantage of the Postal Service's low rates while overwhelming it with packages. The House is set to vote on legislation on Saturday to provide $25 billion to the USPS, while the Senate GOP is preparing a relief bill with $10 billion for the agency. Postmaster Jerry Lewis DeJoy is set to testify at a House committee hearing over the next week over the recent service changes. And meeting minutes out today from the Federal Reserve's policy-making body, it's expressed concern about the coronavirus's ongoing impact on the economy. We've got the details from FX Street senior analyst Joseph Trevisani. Joseph, great to see you as always.
Thank you for having me. It's nice to be here.
Joseph, what were your main takeaways from the Fed's minutes today?
Well, I think the most important one is that the Fed economists are warning the governors that they think the economy is going to be even slower than they predicted at the last set of economic projections. There's a new set out in September, about a month from now, and so that will have some effect. When you get the Fed economists, the Fed has always said that these are projections, they're not to be taken as predictions, but the market views them as the Fed's predictions for what's going to happen, both for the economy and especially for their view on the forward view for Fed funds rate, for the interest rates. So if those are going down again, then that will again keep the markets interested in the fact that the Fed may have to do more, or the Fed may think that they may have to do more. They may have to lower rates. And if not the Fed funds rate, the Fed has already said that they really don't want to get involved with negative interest rates, then the Fed's programs, the buying programs, are still out there, and they could force rates a bit lower doing that. So I think that's probably the main takeaway. The second one, there's been a good deal of talk about yield curve control, which would be a specific target announced by the Fed for longer-term rates. The Fed expressed some skepticism about that in the meeting, whether or not that would be of a benefit and whether or not that's something they would do. In my view, it's probably unnecessary because the Fed is already doing that, essentially. If you look at an important commercial rate, say take the 30-year mortgage rate, 30-year for buying houses, that's already at historic lows. And one of the reasons it's there is because the Fed has been in the market buying various instruments to force rates lower. So you already have that. The main difference, as proposed, as posited, although we don't have any real policy, would be that the Fed gives a specific target for a specific longer-term rate. Since that would really involve losing their own flexibility, I don't think it's something the Fed is going to do, and that seems to be what they were expressing in the minutes today.
Are you surprised that the people at the Fed might be, in the near future, revise down their economic outlook?
No, not really. The Fed has been, of all the government agencies and the government itself, the Fed has been the most out front about meeting the economic problems from the pandemic. I mean, the Fed got started before anybody else. In early March, they were cutting rates. And then in mid-March, they again instituted some of their programs. So I'm not surprised. I mean, the Fed is trying to be realistic, and the Fed has warned continually in the person of Chairman Powell about the dangers of this and the problems trying to get the economy to revive. So I'm really not surprised in this case that the Fed is taking a bit of a, not quite dismal, but certainly a worrisome view about the economy going forward.
Joseph, appreciate your insights as always. Thanks for coming on.
It's a pleasure. Thanks for having me.
And stocks turned lower in late trading on Wall Street, fading just after the Fed's minute release. The yield on the 10-year Treasury held steady at 0.67% after rallying back from 0.64% earlier in the morning. The Dow fell 85 points or 0.31%. The S&P 500 fell 15 points or 0.44%. The Nasdaq fell 64 points or 0.57%. Retailer earnings are in the spotlight this week as well, with Target, Lowe's and TJX just releasing their reports this morning. Target posted its best quarterly comparable sales growth. Lowe's also beat expectations, but TJ Maxx suffered at a loss because of store closures and shipment issues.
Several big retailers are reporting earnings today. Target posted its strongest quarterly comparable sales growth ever, rising 24%. That was roughly triple what Wall Street had expected. The biggest driver, its online operations. Digital revenue nearly tripled as shoppers snapped up video games, kitchenware, and clothes using its same-day delivery and in-store pickup services. The retailer also managed to post double-digit growth in August, even as the effect of the stimulus checks waned. Home improvement chain Lowe's also beat estimates for quarterly sales and profit. It's benefited from a surge in demand for paint, tools, and barbecue grills from consumers stuck at home. Lowe's same-day store sales rose over a third. The company says the momentum has carried into August, although it will likely taper off in later months. Meanwhile, off-price retailer TJX posted a bigger-than-expected loss for the past 3 months, sending its shares down about 7%. It's also expecting a slower back-to-school selling season as more school districts rolled back their reopening plans.
Apple is now the first company in the U.S. to post a market value of $2 trillion. Just 2 years ago, it was the first company to reach $1 trillion. Apple shares have gained nearly 60% this year. The company overcame factory shutdowns in China and retail closures during the pandemic. Apple's loyal customer base continued to buy iPhones and other Apple devices online while stuck at home during the lockdowns. Apple has been at the lead of the 5 big U.S. tech companies. Together, they account for nearly 25% of the S&P 500's entire value. And over 30 trade associations are appealing for an alternative to President Trump's executive order on deferring payroll taxes. They're arguing that while the president's action is well-meaning, it creates the uncertainty of a big tax surprise next year.
A coalition of business groups are calling on the Trump administration and Congress to work out a different form of tax relief for Americans. President Trump signed an executive order postponing employee payroll taxes. Trump's action puts more money in workers' pockets now, but the tax liability is not removed. Employees get a relatively small benefit with each paycheck, but they will owe a lot in 2021. For example, someone making $50,000 a year will get about $120 more per biweekly paycheck. But in 2021, they'll have to pay back around $1,000. The trade groups, including the U.S. Chamber of Commerce, say that unless the payroll tax deferral is made permanent, the bigger tax bill down the road will mean greater pain. But a top Trump administration official told the Epoch Times that even if Congress refuses to make the payroll tax cut permanent, quote, the deferral still effectively allows working Americans to get a sizable advance on their pay starting in a month, which is just when working Americans need it most, as we are fighting to end the COVID-19 pandemic, unquote. The business groups said that given the uncertainty, many employers will ignore Trump's order and keep collecting payroll taxes and paying them to the government on behalf of their employees.
Delinquencies on government-backed Federal Housing Administration loans are at all-time highs and rising. Will we see a wave of foreclosures? Will the government be forced to bail out the program? And is now the right time to buy? We asked Edward Pinto, director of the Housing Center at the American Enterprise Institute. Edward, a real pleasure to have you back on the show. Thanks for coming on again.
My pleasure. Thank you for inviting me.
Edward, we see mortgage delinquencies, they're rising quite steadily, if not sharply, all across the country, particularly these Federal Housing Authority government-backed loans. Do you think, are we facing a wave of evictions across the country?
I think we're ultimately going to face a pretty substantial wave of foreclosures. It will not be as bad, I believe, as last time in the aught years. However, it will be quite severe, particularly for, as you say, Federal Housing Administration borrowers or FHA borrowers. Those are really that's the government's subprime program. Those borrowers are taking out loans with very, very low down payments, very high debt ratios, so they have very little income left after they pay each mortgage payment, and they have generally very poor credit in terms of a credit score. And you put all that together, and almost all of the borrowers have all three. So it's risk layering, which is the most dangerous thing you can do in mortgage lending, and FHA does that in a very substantial way.
So Edward, obviously these are government-backed loans. Are we looking at a large taxpayer bailout for these loans?
So yes, these are government-backed. FHA is directly backed by the government since it's part of the government, as is the Veterans Administration and the Rural Housing Service. They're all part of the government, they're government agencies. They account for perhaps 30% of the mortgages in the United States, maybe 30 to 35%. There's another group of agencies, but they're not part of the government directly, and that's Fannie Mae and Freddie Mac, although ironically today they're owned by the government, but that's because they were taken over back in the last crisis, and they're still under conservatorship of the government. So all told, the taxpayer is really on the hook for about 85% of all home purchase mortgages in the United States. But the ones that present the biggest problem and risk to the taxpayer are FHA. And that's because FHA is the subprime lender in the United States today. And it's quite large. As I said, it has a very large footprint. At this juncture, I can't say whether FHA will have a capital exhaustion where they'll have insufficient capital, which then leads directly to a bailout by the taxpayer because they are a government agency.
We might have many viewers who are considering taking advantage of the low mortgage rates we see at the moment and buying maybe this summer. Are they better to wait, do you think, Edward?
It really comes down to the market's extremely hot right now. House prices are going up like gangbusters. Demand is through the roof. Supply is limited. So house prices, we think, today in August, which these loans won't close. If someone did a purchase contract today, which really sets the price of the house they're buying effectively today, but that loan doesn't close until sometime in October. It takes time for that loan to close, and that's when it gets reported as a closed loan and then looked at as, the house prices for loans that close in October or whatever. But those are really loans that were taken out. The purchase contract was in August. We look at real-time data that helps us see what's going on in real time, and we think rates are going up. Not rates. We think that home prices nationally are going up about 10% or more year over year at the current time. That's a completely unsustainable level. That is much higher than it was earlier in the year, and it was pretty healthy then, and it's the highest it's been in a number of years. Where the issue comes in is if you're buying at the lower end of the market, where the prices are still going up pretty quickly, but it's one of those cities that I mentioned, then you're buying potentially near the top of the market, and then 6 to 12 months from now, you may start seeing house price declines in those places that were just experiencing 7, 8, 9, 10, 11% house price increases. They could quickly go to house price declines.
Edward, I really appreciate you taking the time. Thanks so much for coming on.
My pleasure. Thank you.
And still to come. As Edward mentioned, some current mortgage holders are struggling, but new builds are on the rise. We hear how Zillow and the new home company are innovating to make it easier to move. And the State Department is urging U.S. colleges to get rid of their Chinese stocks in case they get delisted from U.S. exchanges. More on that after the break. The New York Stock Exchange listed the new home company is forming a partnership with home finding app Zillow. Homeowners buying a new home company property will now be able to sell their old home directly to Zillow for cash, so they don't need to worry about showings or even repairs. I caught up with the new home company's CEO, Leonard Miller. Leonard, great to see you. Thanks for coming on.
Thanks for having me. I really appreciate it.
Leonard, exciting partnership with Zillow. Maybe you can let us know, how is it going to benefit homeowners particularly?
Yeah, thanks for asking. I mean, simply is about 2/3 of all home buyers have a home to sell. And so when they come into a community and they're interested in one of our homes, it may be a home that could be completed and delivered within the next month, or it could be 8 months. So this is a vehicle where they can work with Zillow, and we put them in contact with Zillow. Within 24 hours, they'll get a response, and they'll have an offer on their home within 7 days, and the ability to close that home within anywhere from 2 to 4 weeks, out to 8 or 9 months. So what it does, it takes all the stress away from a home buyer on saying, hey, I'd love to buy this new home, but now I've got to go through the process of finding a buyer for my existing home, and will that timeline work with my purchase decision?
And I can imagine having that, we'll call it a window of time to sell a home, probably can expect to get better price as well, right?
Well, I think that's right. It depends on the market, obviously. But I think, again, one of the things is just figure you walk into a new home community and you see a home that you fall in love with. If you have your home to sell and we have no certainty that it might take 60, 90 days to sell your home, that puts you at a disadvantage to another prospective buyer who doesn't have a home to sell. So again, that relieves that obstacle and gives you a chance to get into that new home with this option.
I see. I think it's a great partnership. I look forward to it. And it's been quite the year for home builders overall. Do you guys expect the demand to continue right through the winter?
It sure seems to be. I will tell you, with the onset of COVID-19, I think we all sat here in mid to late March and anticipated the worst. And the market seemed to really trough and bottom around the middle of April, around Easter weekend. And subsequent to that, I can tell you in our markets in California and Arizona, it's just gotten stronger and stronger because there's no inventory out there and historically low interest rates. So the market's been the best it really has been since the early 2000s. And I would anticipate through the end of the year and into early next year, it's going to remain really strong from what we see.
And I know here in New York, we've seen a kind of trend of people wanting to leave the denser areas and move out a little bit. Do we see the same on the West Coast?
We sure do. I got to tell you, from major urban centers like San Francisco and the Silicon Valley, we're seeing a flight to the suburbs, going to Sacramento. We're seeing that in Southern California, and we've seen a lot of that over the last 3 to 4 months. And I tell you, we're a great example of that. We have about 2/3 of our employees working from home today. And it gives them long-term options, because I think employers are going to be more flexible with flex schedules, which allows them to basically work from home part-time or full-time and not make that commute into urban centers. So we definitely see that trend.
Interesting times. Leonard, I wish you guys all the best with the new partnership, and we'll catch up again soon. Thank you.
Thank you very much.
And still to come, a restaurant alliance in New York City is demanding indoor reopening plan. It says they need to open up fast in order to survive. More on that after the break. New York City's restaurants still aren't allowed to reopen indoor dining. A nonprofit group says it doesn't make any sense and it wants New York officials to let them reopen. NTD's Phil Zoe has the details.
The New York City Hospitality Alliance says it's time to let restaurants in the 5 boroughs reopen indoor dining. They have not been allowed to yet, despite meeting all the requirements subjected to other counties in the state. Government officials have no concrete plans on when that might happen. The Hospitality Alliance Group represents New York City restaurants. It says they need to reopen as soon as possible, with at least 50% capacity indoors to save them from shutting down, and that state officials need to support restaurant owners. It held a press conference to address the concerns.
We demand a plan. Safety, public health must be paramount, but our economic health must also be paramount as well. Please, it's urgent. Give these people the information and support they need.
Andrew says New York City restaurants are devastated. Owners are upset that reopening for indoor dining has been delayed for over a month in New York City since early July. Restaurants, unlike other businesses, need time to prepare for reopening. They need to stock up on products and rehire workers, which takes time.
When? What is the plan? We need to be prepared. We have to budget our way into reopening.
One owner had to close her restaurant of 13 years because of the pandemic.
It was a tiny little diner called Jimmy's Diner. It was a half block from my house. I raised my 3 kids in there.
The owner of a Michelin-noted restaurant says October, November, and December are the months where he needs to make money. It's how he survives January, February, and March, the bad months for the restaurant business.
And unfortunately, going to see a lot more restaurants closing up because at 50%, we're not going to make the money that we need to make and put aside to survive those months.
The group says some restaurants might not be around to reopen if indoor dining remains closed in New York City, especially when summer is winding down and the colder months are approaching. Phil Zoe, NTD News, New York.
And the U.S. State Department has sent a letter to U.S. colleges and universities, warning them to divest from Chinese stocks in their endowments in case Chinese companies get delisted for not complying with U.S. standards.
The U.S. State Department is warning colleges and universities to divest from China stocks. Bloomberg reports that State Department Undersecretary Keith Krach sent a letter to American colleges and universities on Tuesday. He wrote it would be prudent to divest from Chinese stocks because they will likely be delisted from the U.S. exchanges by the end of next year. A Bloomberg investigation last year found that college and university funds represent billions of investment in Chinese firms. Endowments have directed growing portions of their investments into Chinese companies that U.S. politicians say threaten national security and are linked to human rights abuses. U.S. regulators recently requested that American stock exchanges set new rules that could trigger the delisting of Chinese companies. Concerns are investors are being exposed to fraud. The State Department letter also warns of China's growing influence on U.S. campuses. It says the U.S. is investigating illicit PRC funding of research, intellectual property theft, and recruitment of talent.
That's the latest business updates for today. Thanks for tuning in. We'll see you tomorrow.